Hello, I'm Ron Wilson. In this month's news, Federal Treasury has released draft regulations for the life insurance framework to address the points raised by industry participants during the consultation process. In line with Recommendation 9 of the Financial System Inquiry, the federal government has committed to enshrine the objectives of superannuation in legislation. And in international news, the US Federal Reserve has talked down the prospect of future rate rises in 2016 in light of risks to the global economy. Michael Pollock has the details.
Federal Treasury released draft regulations for the life insurance framework in April, which addressed a number of issues and concerns that the industry had raised during the consultation period on the legislation. Under the proposed regulations, three of the key issues addressed were providing a 12-month transition period during which stamp duty relating to death benefits may be included in the calculation of commissions in order to allow time for all necessary system changes to be made so that stamp duty can be excluded in the future, prescribing certain limited circumstances, in essence self-harm or a reduction in the health risks of the insured, under which clawback arrangements are not intended to apply, and grandfathering of existing employee-employer remuneration arrangements entered into prior to the commencement of the LIF reforms in a manner broadly consistent with that under the FOFA reforms. The federal government recently made the commitment to enshrine the objectives of superannuation in legislation as recommended by the Financial System Inquiry. The move was praised by many industry associations including the FSC, ASFA and the SMSF Association. According to the FSC CEO Sally Lone, a clearly defined objective for superannuation with broad public support would strengthen the confidence in stable, long-term settings for what is our only truly intergenerational public policy. Despite rising underlying inflation and a strong jobs market with low unemployment, the US Federal Reserve is delaying the pace of its planned increases in interest rates. It now appears that in place of the 4 interest rate hikes it had earmarked for the year, the Fed appears likely to only raise rates twice due to concerns it holds over risks in the global economy. Some of the international factors of concern to the Fed include the almost certain downgrading of global growth forecasts by the IMF, softening growth in China, reducing capacity of the authorities to handle instability in their equity, credit and currency markets, the effect of economic slowdown on the major trading partners of the US, which is pushing up the value of the US dollar and hurting local US manufacturers, negative interest rates and asset purchases by the Bank of Japan and the European Central Bank, leading to depreciation of the yen and euro, which also puts upward pressure on the US dollar, and the uncertainty surrounding the Brexit referendum scheduled for 23 June to decide whether or not the UK will remain in the European Union. The Bank of Japan's quarterly Tankan business survey for the March quarter showed business sentiment among large manufacturers deteriorating sharply to hit a near 3-year low. The index fell from 12 to just 6, which was below market expectations. However, at least it remained above 0, which meant that optimists outnumbered pessimists. Business conditions were hit by a strong yen and very weak domestic and global demand, which cast more doubts about the ability of Abenomics to rekindle economic growth. Rising global uncertainty and faltering demand also prompted large manufacturing enterprises to become more pessimistic about the country's economic outlook for the next 3 months. Research released in March suggests that full-time Indigenous Australian workers face a retirement wealth gap of 27% and 39% for males and females respectively, compared with the median non-Indigenous male worker. The research, conducted by the CSIRO Monash Superannuation Research Cluster, modelled the superannuation balances of a full-time employed Indigenous worker against that of a non-Indigenous worker over a 40-year investment horizon. Participants were assumed to contribute 9.5% of their pre-tax income into their superannuation fund until retirement at age 65, and that current median income levels and historical asset returns continue over this investment period. Asset allocation is based on a typical default fund. Based on these assumptions, the paper found that Indigenous full-time workers will, on average, retire with approximately 27% less in superannuation savings than non-Indigenous workers. The 27% gap translates to a potential $165,000 less in superannuation over a 40-year working life for the average Indigenous worker at age 65. ASIC has released a consultation paper which sets out its proposed approach to the regulation of digital product advice in Australia. Consultation Paper 254, Regulating Digital Financial Product Advice, released in March, and the accompanying draft regulatory guide do not propose to establish new regulation, but detail how existing legislation applies to digital financial advice. ASIC explained that its guidance follows direct engagement with digital advice providers about their business models. During that engagement, it became clear that digital advice providers would benefit from additional ASIC guidance specific to digital advice. The closing date for comments with regard to CP 254 is 16 May 2016. The RBA left interest rates unchanged in its April meeting, but at the same time made some changes to the accompanying statement to reflect recent developments in financial markets. The most significant change to the post-meeting statement was the concern it recorded over the impact of the rising value of the local currency. RBA Governor Glenn Stevens said that an appreciating exchange rate could complicate the adjustment underway in the economy. The RBA board noted that while commodity prices were a little higher more recently, they were rising from a very low base, which implies it saw the recent rise in the currency as more than merely in line with commodity prices.